Let me first say that growth in the Eurozone is in positive territory. And there was time when the expectation was different. What is affecting Europe are three factors. First, they are highly dependent on energy imports in comparison to the United States that is actually exporting now oil and gas. Europe has to deal with the higher energy prices. Second, productivity in Europe is lagging behind the United States. And three, what we see in Europe is the aging population is not being compensated as much with immigration as the needs of the labor market are. And as we know, immigration is a complicated matter. But I am encouraged to hear European leaders talking seriously about the need to boost productivity and growth. And on that basis, we just had a discussion on the EU budget and how the EU budget can play that role. On the inflation front, Europe is closer to its target than the United States, and the trend in Europe is more stable downwards, meaning that we are likely to see the European Central Bank to be in a position to take action on interest rates earlier. And that would be really good because high level of debt mean also high level of debt service, throwing more cold water on what is in any case slow growth.
Very clear. Let's talk about the economic picture, because at this stage I was just wondering whether the IMF thinks that there's a chance the Eurozone will get soft landing right. Because there are a lot of question marks about that. Is the ECB managing to achieve that?
What we have seen is ECB is very cautious and is looking at data points carefully. They are not going to jump the gun if data points are not confirming that time has come to cut. Our staff's view is that around June there may be the conditions for ECB to take this first step. And I'm confident they would be prudent in what is then to follow. Let's remember, one cut is not going to bring interest rates down to a point to ease developments in the economy. So further action also has to be very careful. Different from the United States, ECB has to watch 20 members that share the same currency and conditions in these countries. It makes the job of ECB more complicated, but again, they have been very prudent up to now, and I'm confident they'll continue.
Managing Director, in the past you've told me about potential concerns when it comes to monetary policy divergence. Mm-hmm. And this is another theme now when you compare the ECB and the Fed. Mm. Is this a concern that you have also at the moment?
Yes, we are concerned that no more central banks can march on the same tune. Clearly in the US the picture is not as consistent as it is in Europe. Also growth in Europe is more subdued than it is in the United States. So conditions for ECB to take action earlier are already shaping to be in place. We are not too worried about the exchange rate impact because our analysis shows that 50 basic points difference is likely to lead to minuscular 0.1 to 0.2% shift in exchange rate. And that is to say that here this is not a big issue. It is a much more serious issue for countries where the impact of high interest rates in the United States are more profound. In many emerging market economies, we also see some of this in Japan. And there, the attention of policymakers indeed has to be sharpened to carefully monitor whether volatilities are becoming more significant. In Europe, this is not the case.
So the ECB has more room for maneuver for now.
Indeed, yes.